Wallenius Wilhelmsen ASA (WAI) is a global leader in the integrated roll-on, roll-off (RoRo) shipping and vehicle logistics sector, managing the complex distribution of cars, trucks, and high and heavy equipment across 15 trade routes with a fleet of approximately 125 vessels. The firm's recent financial performance has been outstanding, culminating in 2024 achieving the best financial results in company history, marked by an adjusted EBITDA of $1.901 billion and a net profit of $1.065 billion. This operational excellence is further affirmed by superior capital efficiency metrics, including a return on capital employed (ROCE) of 19.9% and a return on equity (ROE) of 39.6%. The investment thesis surrounding Wallenius Wilhelmsen resides in a significant dichotomy. The company exhibits robust operational fundamentals and an aggressively deleveraged balance sheet, yet its public market valuation is profoundly compressed. The current price-to-earnings ratio (PE ratio) hovers around 3.30 times, and the enterprise value to EBITDA (EV/EBITDA) is approximately 3.14 times. Such multiples are typically reserved for firms facing severe cyclical collapse or imminent structural deterioration. The driver of this extreme valuation compression is identified as the sudden and material regulatory shock arising from the proposed increase in U.S. port fees for foreign-built RoRo carriers. These fees are set to rise drastically from $14 per net ton to $46 per net ton, imposing an estimated unmitigated annual financial exposure of between $350 million and $400 million. This regulatory change compelled management to suspend its 2025 financial guidance. The prevailing market discount reflects the explicit capitalization of this massive potential cost into the enterprise value, based on the pessimistic assumption that the company will be unable to successfully pass this cost increase through to its primary customers, the global original equipment manufacturers, OEMs. The forward investment analysis, therefore, must focus on assessing the financial resilience of the firm to absorb this shock and its strategic capability to transfer the new costs within the context of a highly capital-intensive industry. I. Commercial and operational landscape assessment. A. Market position and revenue concentration. Wallenius Wilhelmsen is a dominant force in marine shipping, deriving maximum revenue from its shipping services segment, which focuses on the ocean transport of vehicles and RoRo cargo for car manufacturers and producers of construction and high and heavy equipment. The firm's operational structure includes a fleet of 125 vessels, a global inland distribution network, 66 processing centers, and 7 marine terminals, establishing an integrated multi-segment logistics chain. A critical element of the revenue profile is its geographical concentration. The majority of revenue is currently derived from the Americas region. This concentration makes the operational profitability disproportionately sensitive to regulatory and economic policy changes originating in the United States, which is the precise mechanism of the current uncertainty. The risk is not merely an industry-wide tariff, but one that specifically targets the geographic and segment concentration of WAI's most profitable operational areas. While the company maintains a diversified client base across agriculture, automotive, mining, and power industries, the dependence on the U.S. market exposes the current profit base to targeted regulatory risk, mitigating the benefits of industry diversification. B. Strategic investments and operational efficiency. The company's commitment to strategic investments is evident through its pursuit of sustainable shipping practices, fleet modernization efforts, and digital transformation initiatives. These are embodied in projects such as the ongoing Shaper vessel program, designed to deliver 14 new vessels, preparing the fleet for future demands and environmental regulations. Maintaining a modern fleet necessitates significant capital investment, leading to substantial non-cash charges in the form of depreciation and amortization, D&A, which is discussed in the cash flow analysis. Operational metrics remain highly positive despite the looming regulatory clouds. Adjusted EBITDA for Q3 2025 was a strong $471 million, which management projected to be mirrored in Q4 2025 before accounting for the potential negative impact of the U.S. port fees. Management has further indicated expectations for strong utilization in 2026. This persistent operational strength and high utilization expectation suggests that the underlying demand fundamentals and the company's structural pricing power within the RoRo market remain robust, reinforcing the thesis that the valuation discount is regulatory-driven rather than cyclically induced. The resilience of EBITDA indicates that operational margins are strong enough to withstand significant cost pressures, provided they are not wholly retained by the company. 3. Detailed analysis of cash flow generation. A. Operating cash flow profile and robustness. For a capital-intensive asset owner like Wallenius Wilhelmsen, operating cash flow is the superior measure of financial health, as it reveals the true cash-generating capability independent of non-cash accounting charges. The company demonstrates an exceptional conversion of earnings into cash, largely due to high depreciation and amortization expenses associated with its large fleet. Reviewing the historical figures illustrates this strength. In fiscal year 2022, OCF stood at $1.297 billion. This surged to $1.771 billion in 2023 and remained highly stable at $1.762 billion in 2024. For the trailing 12 months, TTM, ending September 2025, OCF increased further to $1.797 billion, significantly exceeding the reported net income of $1.124 billion for the same period. The primary driver of this positive variance is the D&A charge, which contributed $629 million to OCF in TTM SEP 25. This non-cash D&A acts as a critical cash shield, structurally boosting operating cash flows relative to net income and providing a consistent internal funding source. The vast scale of the operating cash flow, nearing $1.8 billion annually, is highly relevant when assessing the regulatory risk. The estimated unmitigated annual financial exposure from the U.S. port fees is $350 million to $400 million. In the hypothetical worst-case scenario, where the company absorbs the maximum fee, this cost represents only 20 to 22% of the annual operating cash flow. This comparison demonstrates that while the fee constitutes a severe blow to net profitability and margins, the underlying operating cash generation capacity remains robust enough to manage the shock without immediately jeopardizing the core operations or strategic financial autonomy. B. Free cash flow and capital allocation. Free cash flow, FCF, provides a measure of discretionary capital available after funding necessary maintenance and expansion CapEx. Wallenius Wilhelmsen has maintained relatively controlled capital expenditure despite its strategic fleet renewal programs. Capital expenditures, CapEx, have been increasing moderately in line with strategic investments, rising from $103 million in 2022 to $151 million in 2023, $195 million in 2024, and reaching $225 million in the TTM ending September 2025. Given the TTM OCF of $1.797 billion, the resulting estimated FCF for the period is exceptionally high, approximating $1.572 billion. This prodigious FCF generation capacity is confirmed by the remarkably low enterprise value to free cash flow, EV to FCF, multiple of 3.73 times as of December 2025. This low multiple confirms that based on current cash flow generation, the market is severely undervaluing the company's ability to produce cash for shareholder returns or future investments. The deployment of this robust FCF has been disciplined, reflecting financial prudence by management during this high profit cycle. A primary allocation has been aggressive debt reduction, with long-term debt repayments totaling $933 million in 2024 alone, contributing to a net debt repayment of $941 million in TTM SEP 25. The parallel priorities of returning capital to shareholders via record dividends and funding strategic fleet renewal highlight management's strong conviction in the durability of high FCF generation and the structural health of the business model. IV. Balance sheet strength and solvency evaluation. A. Capital structure and deleveraging success. The company's balance sheet structure has been significantly fortified by the recent aggressive deleveraging campaign. The net effect of this strategy is a highly resilient capital base positioned strategically to absorb unexpected shocks. The equity base is substantial, reaching $2.695 billion as of the end of 2024, resulting in a solid equity ratio of 39.5%. For a deeply capital-intensive industry, this equity foundation provides a robust reserve against cyclical pressures or unanticipated asset devaluations. More critically, the company's operational leverage is remarkably low. The leverage ratio, net debt to adjusted EBITDA, stood at just 0.9 times in 2024. This indicates that the company could extinguish its total net debt using less than 1 year of its current EBITDA generation, demonstrating extremely high financial safety. This low leverage provides maximum strategic flexibility, allowing the firm to navigate the potential $350 to $400 million regulatory cost without immediate threats to solvency or access to capital markets. The absolute level of interest-bearing debt also decreased significantly, dropping from $608 million at the end of 2023 to $434 million at the end of 2024. While the reported debt-to-equity ratio of 94.92% might appear high in a general industrial context, in the asset-heavy maritime sector, this level, coupled with the low 0.9x EBITDA leverage, is considered manageable and healthy. The high proportion of reliable long-term assets and predictable operating cash flows mitigate the risks typically associated with such a debt-to-equity ratio, confirming that the high ROE is structurally sound. B. Liquidity position and working capital metrics. Wallenius Wilhelmsen possesses substantial liquidity reserves, which serve as the primary hedge against unforeseen operational volatility and regulatory costs. Total liquidity reserves stand at a commanding $1.72 billion, including a cash balance of $1.079 billion. This reserve is arguably the most critical balance sheet metric in the face of the immediate U.S. port fee uncertainty, as it provides a multi-quarter buffer to cover costs if initial pass-through negotiations prove challenging. In terms of working capital, the current ratio, 0.87, and quick ratio, 0.69, as of December 2025, technically fall below the conventional 1.0 benchmark for financial safety. In standard corporate analysis, this suggests that current liabilities exceed current assets, potentially indicating short-term liquidity strain. However, in the RoRo shipping sector, where invoicing and collections from major global OEMs are highly predictable and inventory requirements are minimal, these low ratios are often structurally benign. The sheer scale of the $1.7 billion cash and liquidity reserve provides overriding reassurance that the company is highly capable of meeting short-term obligations, rendering the technical working capital ratios less critical in this context. C. Superior returns on capital. The firm's efficiency in deploying capital is evidenced by its exceptional profitability metrics. The return on equity, ROE, stands at an extremely high 39.6% TTM Dec 25. Simultaneously, the return on capital employed, ROCE, was 19.9% in 2024. For a business model requiring immense upfront capital investment in vessels and logistics infrastructure, generating nearly a 20% return on all deployed capital demonstrates highly effective asset utilization and strong operating margins. The high ROE is often a function of financial leverage. However, in Huawei's case, the high return is primarily driven by superior operational performance and rate strength rather than excess debt utilization. The low operational leverage, 0.9x net debt/EBITDA, confirms that the financial risk is controlled, suggesting that the exceptional capital returns are rooted in commercial strength, making them more resilient provided the regulatory cost challenges can be managed. The large cash balance serves as an immediate shock absorber. The $1.7 billion liquidity reserve could potentially cover over 4 years of unmitigated Q4 25 financial exposure, $100 million per quarter, allowing management ample time to restructure contracts and implement cost pass-through strategies. V. Valuation landscape, discrepancy and market fear. A. Extreme valuation compression in relative multiples. The market valuation of Wallenius Wilhelmsen is highly unusual, displaying extreme compression relative to both its own history and industry peers, which suggests a deep-seated fear concerning future earnings sustainability. The price-to-earnings ratio is reported at 3.30 times, TTM November 25, and 3.6 times. This level of compression is symptomatic of market expectations for a massive, near-term reversion of earnings to a lower mean. This multiple is significantly below the European shipping industry average PE of 9 times and the peer group average of 4.4 times. Furthermore, historically, the company's PE has been highly volatile, with a 10-year mean historical average of negative 8.38 times, reflecting the cyclical volatility inherent in the maritime transport industry. The current low PE stands in sharp contrast to this history, suggesting that the market is attempting to price in more than just cyclical mean reversion. It is pricing in a structural earnings deficit. Similarly, the enterprise value to EBITDA multiple has experienced a severe collapse, trading at 3.14 times TTM Dec 25, down from 8.9 times for the 5-year average, 2020 to 2024, and a peak of 19.6 times in 2020. The 24 EV to EBITDA stood at 3.0 times. This drastic decrease suggests that the market is applying a substantial risk premium, directly reflecting the anticipated cash drain from the U.S. port fees. Specifically, the regulatory cost exposure of $350 to $400 million is being capitalized into the enterprise value, creating a deep discount that acts as a proxy for the anticipated reduction in future cash flows. B. Intrinsic value and analyst dissonance. Intrinsic valuation models, which account for future cash flows, corroborate the thesis of dramatic undervaluation. One such analysis suggests the company is currently 65.5% undervalued, with a fair value estimate of NOK 277.32 against a current share price of NOK 95.70. This gap highlights the significant opportunity for appreciation if the regulatory risks can be successfully mitigated. Moreover, the price-to-book ratio of 1.14 times suggests that the company is being valued only slightly above the tangible liquidation value of its assets, which is extremely low for a market leader commanding high operational returns, ROCE 19.9%. However, the investment community's consensus remains cautious. Despite the compelling valuation metrics, the analyst consensus rating is neutral. Out of 15 analysts who recently assessed the stock, the buy consensus is only 44%. More tellingly, the average 12-month price target is set to imply a downside of between 5.78% and 6.94% from the current price. This analyst sentiment is highly contradictory to the quantitative indicators of undervaluation. This dissonance suggests that professional analysts are acutely focused on the unquantifiable risk introduced by the suspended guidance and the looming U.S. port fee liability, prioritizing regulatory uncertainty over fundamental financial strength. The current depressed price point therefore reflects the market waiting for definitive proof of cost pass-through capability before re-rating the stock. V. Dividend policy and financial safety. A. Dividend policy framework and record payouts. Wallenius Wilhelmsen's dividend framework aims to provide shareholders with competitive returns, utilizing a pay-as-you-go philosophy. The official policy targets a dividend that shall constitute 30 to 50% of the company's profit after tax on an annual basis. Dividends are declared and paid semi-annually in USD, based on net profit and paid out in NOK. The board also reserves the right to consider extraordinary dividends or share buybacks when the financial position allows, emphasizing a commitment to returning excess capital. The extraordinary profitability of 2024 led to the highest dividend paid in company history, resulting in a total payment of $1.85 per share linked to 2024 earnings. This payout corresponds to an extremely high trailing dividend yield of 38.87%. B. Sustainability of dividend payments. The sustainability of future dividend payments must be judged against the policy's payout ratio target, 30 to 50%, rather than the exceptional 2024 yield. While the 2024 net profit of $1.065 billion comfortably covered the record payout, the forecast for future dividend payments is materially impacted by the U.S. port fee uncertainty. Assuming the worst-case scenario where the entire $375 million midpoint of 350M to 400M regulatory cost is absorbed by the company, the net profit would potentially be reduced to approximately $690 million, significantly lower than the 2024 record. If the company adheres strictly to the top end of its policy, 50% payout ratio, this would translate to a total dividend payout of approximately $345 million. While this payout would be substantially lower than the extraordinary 2024 level, it would still represent a very robust, policy-compliant dividend. More fundamentally, the dividend safety is structurally supported by the massive free cash flow generation, more than 1.5 billion TTM. This FCF is ample to cover both current low capex levels and a policy-compliant dividend payout, even if profitability is significantly compressed by the U.S. port fees. Therefore, the risk is not dividend elimination, but dividend normalization towards the statutory 30 to 50% payout range relative to potentially reduced earnings. The highly elevated current yield is an artifact of record performance and is unlikely to be maintained regardless of the regulatory outcome. The proactive financial strategy of management, prioritizing heavy debt repayment alongside record payouts, suggests deep internal confidence in the sustained long-term cash generation capabilities of the fleet. 7. Critical risk assessment and forward outlook. A. Quantification of U.S. port fee impact and management response. The imposition of the increased U.S. port fee represents a quantifiable and material threat to the near-term financial outlook. The fee adjustment, raising costs from $14 per net ton to $46 per net ton for foreign-built RoRo vessels, took effect on October 14, 2025. The immediate financial consequence is severe. The company estimates an unmitigated cost exposure of approximately $100 million in Q4 2025 alone, escalating to an annual exposure ranging from $350 million to $400 million in 2026. This estimated annual cost equals a substantial portion of the company's recent record net profit. The magnitude of this exposure, significantly exceeding prior expectations, prompted Wallenius Wilhelmsen to suspend its full financial outlook for 2025 until further clarity on the financial impacts and mitigation strategies could be established. B. Mitigation strategy and cost pass-through nexus. The overriding determinant of WAY's future valuation and profitability is its capacity to successfully mitigate and largely pass through these increased costs to customers. Due to the chronic global supply constraint in the specialized RoRo shipping market, WAY possesses significant structural pricing power. The successful transfer of the cost hinges on whether major customers, such as automotive OEMs, acknowledge the fee as a non-negotiable regulatory imposition on the supply chain, or whether they attempt to categorize it as a discretionary rate hike. If the RoRo market remains tight, as implied by management's forecast of strong utilization in 2026, the likelihood of a high degree of pass-through is elevated. If a significant majority, e.g. 75% or more, of the $350 to $400 million cost is successfully transferred, the valuation discount applied by the market is fundamentally incorrect, and the company is deeply undervalued. Conversely, if the company is forced to absorb the costs due to competitive pressures or protracted customer negotiations, the projected net income decline would largely justify the current compressed valuation multiples. C. Outlook and path to resolution. The current period of valuation compression offers a high-risk, high-reward entry point, driven entirely by the regulatory uncertainty. The current analyst consensus rating, which implies a negative return over the next year, reflects the cautious stance adopted by the market in the absence of firm forward guidance. The financial strength of the company, demonstrated by its $1.7 billion in liquidity reserves and aggressive deleveraging, provides a crucial protective layer. This liquidity buffer ensures the company can absorb several quarters of the unmitigated fee impact while simultaneously engaging in complex cost restructuring and passing negotiations with major clients. The highest conviction return for investors is anticipated to occur when management successfully provides new positive financial guidance, confirming that the net impact of the U.S. port fees has been substantially offset by cost pass-through mechanisms. 7. Conclusion. Wallenius Wilhelmsen ASA presents a case of operational momentum colliding with sudden material regulatory risk. The analysis confirms the firm's exceptional financial health across the core areas of scrutiny. Cash flow. Operating cash flow is exceptionally high, near 1.8 billion TTM, resulting in massive free cash flow, more than 1.5 billion, providing superior coverage for both strategic capex and capital returns. The 350 to 400 million regulatory threat, while large, is manageable against this base OCF. Balance sheet. The capital structure is robust, characterized by historically low operational leverage, 0.9x net debt over EBITDA, and over $1.7 billion in liquidity, establishing a formidable financial buffer against unforeseen shocks. Valuation. The market trades the stock at valuation multiples, PE 3.30x, EV/EBITDA 3.14x, that aggressively price in a structural reduction in future profitability, reflecting the full unmitigated risk of the U.S. port fees. This indicates a dramatic undervaluation if cost pass-through is achieved. Dividend safety. The dividend is financially safe based on the company's strong FCF coverage and adherence to its 30 to 50% payout policy, though the extraordinary 2024 yield is not sustainable under a high-cost scenario. The current valuation discount is a direct function of regulatory uncertainty. For a long-term institutional investor focused on the maritime industrial sector, the established market leadership and the strategic deleveraging efforts provide a compelling foundation. The central investment implication is that the market is offering a discounted entry point to a high-quality asset due to temporary, though substantial, regulatory ambiguity. The successful resolution of the U.S. port fee issue will likely catalyze a significant re-rating towards historical and peer group multiples, offering exceptional capital appreciation potential.